Good morning, traders and investors. It's finally Friday. Thank God it's Friday. It's June 24th. It is a Friday. We're starting the last week of June next week. Cyclically, it's a big week for the small caps because we have Russell being restructured. The last week of June, every year, the Russell indexes are restructured. They are repositioned. New stocks come in, old stocks come out, which causes a rally 75% of the time. And I've done some videos, and if you're in my VIP program, you should know about that. I also sent out a Telegram alert yesterday giving everyone that trade as a bonus. So make sure you check out your Telegram channel. Now, it's about 8:07 in the morning. The market's going to open up in a little less than an hour and a half, about an hour and 23 minutes. The Dow Jones is doing pretty well. The NASDAQ is doing pretty well. Russell's kind of still up. I mean, everything is up. But as long as we can maintain this type of bullish climate and close today positive, it'll be very instrumental for causing a rally. But I'm liking what I'm seeing right now. In terms of global economy, we do have consumer sentiment today and new home sales. I'm hoping, and the truth of the matter is, investors are prepared. Last week's Michigan number, or 2 weeks ago, was horrible. But I'm hoping it's coming out at 10 o'clock, about half an hour after the market opens. I'm hoping that the number is slightly better than the top line number, which is 50.2. So if it's like 51, 52, we can really see a good rally. And new home sales, the numbers are in fact coming down. I mean, there's no surprises or miracles out there. So you could see the range is fairly wide. Anything on the upper end of the range will be good. They're expecting the low end of the range. Let's see where it goes. I mean, there's no miracles out there. Interest rates are going up. There's going to be less new home sales. But the market, I believe, is pricing that in and has been pricing that in for a while. Let's talk a little bit about global economy, shall we? So let me just delete this thing here. So first weekly gain after 3 weeks of punishing losses. Man, it's been brutal. It has just been brutal. I believe this last 3 weeks of these losses we've been taking is because of the 8.6 CPI number. That just gave investors more pause that we are in fact peaking out. But I'm going to tell you guys something interesting. It's something that you don't hear a lot from Wall Street. A lot of this data, a lot of this Fed data that we're hearing, it's kind of back. It's slow to come out. So there's a backlog of about 3 to 6 months between what's really happening and data. Because I mean, the data is current, but it's not. It's based on what already happened. So remember, the Fed is reacting based on a lagging timeline, right? And the market prices everything in ahead of time. So we're in a very interesting position right now where the worst may already be priced in and we already may be peaking out in terms of inflation, but we're not going to know about it for the next month or two. But the market would start taking that into account. Most players are looking ahead to U.S. inflation data due next week and hoping that the moderation in price of oil and some other commodities this week is a sign inflation may be abating or peaking out. I don't think that's the case. I think most investors are fearful of a recession because that would put a bearish tone to the commodities as well as stocks, because when there's a recession, there's less global demand for everything, including commodities. Britain's Prime Minister Boris Johnson suffered a double blow as voters rejected his Conservative Party in 2 special elections dominated by questions about his leadership and ethics. I agree with that. The electoral test came as British faces its worst cost of living crisis in a generation, with Russia's war in Ukraine squeezing supplies of energy and food staples at a time of soaring consumer demand while COVID recedes. Very interesting time we live in right now. A report Friday in Japan showed remained 2.1% in May. Inflation remained at 2.1% in May, pushing higher energy costs and weaker currency. However, underlying core inflation, which excludes volatile costs of energy and fresh foods, remained at 0.8%, and the central bank is unlikely to follow the example of U.S. Federal Reserve and other central banks in raising interest rates. They're taking a whole different approach. Now, I want to tell you guys something really interesting. If you take energy and food away from our CPI, our number was constant as well. It didn't go up. So Japan and US are seeing the same thing. The fact that if you take energy and food away, the CPI, the core, it's called core CPI, did not increase. You know how the broad increased to 8.6? The core did not increase. And guess what the Fed looks at? They look at the core CPI. Trading has been turbulent in recent weeks as investors try to determine whether a recession is looming. And that's really the biggest factor that's causing energy and commodity prices to decline. Because while the war is still there, they're going to be higher. But if there's a recession is bad for every asset. Benchmark S&P 500 is, in fact, in a bear market. It drops over 20% from recent high, which was in January. We have fallen for the last 10 out of 11 weeks. It's been brutal, folks. Powell spoke to Congress a week after Fed raised its benchmark interest rates by 0.75 percentage point, its biggest hike in nearly 3 decades. As higher prices stretch their budgets, consumers are shifting spending from big-ticket items like electronics to necessities, something that's been going on for quite some time. And there's pressure of higher gas prices. And the only thing I'm seeing that's going to abate higher gas prices is the end of war. Here's what I'm liking quite a bit. I'm liking the fact that the bond market is now back within its range. When we had the CPI number, it fell off right here, but now it's back within its range, which is telling us that the stock market may be strengthening or that the long bond may be staying steady for quite some time and seeing where the market is and taking in this Fed rate hike as a wait and see approach before going lower. Now, ultimately, I think it will go lower because interest rates will go higher. But right now, with the recession looming and with the Fed using the R word frequently now, after he got reelected, notice Powell, before he got reelected, it's transitory. And now after he got reelected, inflation is a real possibility. That guy, what a politician. Anyhow, we've been moving more sideways, getting out of this choppiness. And if we can stay sideways, it's telling us that the long bond is having major doubt that the interest rates are going to go higher at the rate that the Fed is in fact intending. So keep your eye on the long bond and keep your eye on volatility, because volatility did not make a higher high when the markets made a lower low, and it is back down now. Now, if we can break the 27, 26, come back down to the low 20s, that would be very instrumental to seeing a rally in this market, something we desperately need. In terms of a heat map, we've been seeing a big turnaround. Medical stocks have been going up. Utilities, solar usually goes up when energies go down. Energies have been going down, and basic materials, consumer stocks have been going down because there is a higher threat of a recession, and a recession will not impact medical stocks as much. Financial stocks shouldn't be impacted as much, but there is definitely, without a question, some type of a sector rotation. Look on a cumulative basis, you still have consumer discretionary, communication at the bottom, communication services at the bottom again. But look at the 1 month basis. Energy's at the bottom, materials at the bottom. But then you've got consumer staples and healthcare at the top. I mean, this thing is just not making any sense at all. But we're definitely seeing a sector rotation. For the next few sessions, here's my suggestion to you. Keep your eye on the energy market. Notice the energy is starting to rally again. If the energy market is starting to rally, that means there's a less chance of a recession, because that's what's been really barking up this tree, the recession. Because remember, when there's a recession, everything in the world slows down, including energies, which is what happened during COVID. So if you see energy, food prices, commodity prices rising, that means there's less chance of a recession. If you see the bond market remaining within this range and not going down or even going higher, which would even be better because we can short it, there's less chance of a recession. When you see these type of sector rotations, you want to be very cautious with the market. Now, with all that said, and even with the market showing 11 out of 12 weeks or 10 out of 11 weeks were bearish, which is insane, we've been taking some profits. We took a profit on Merck to the long side. We were in this trade for 21 days. Look at this thing go. I mean, look at that. Even yesterday, it went pretty good. We got into Merck. Let's see. We got into Merck on the 2nd, right here, right there, right here. And we wrote all this down, and boom, we got out on a nice little turnaround right here. Really nice little turnaround right there. We made 21% plus on this trade. Not bad, right? In this kind of crazy market. And we had a CTVA pattern trader trade that we closed out this week as well. And then it started going down again. But We were in this trade for 4 days. We got in on the 17th, right here, right there, and we literally got out on the 21st, right here. And we made 13.33%. We were in the trade for 4 days. Nice, not bad, right? So things are not as bad. And yes, we've been taking profit. Our matter of fact, our closed trades. Let me show you guys something. I think you guys will like this. This is all of my closed trades since October 1st on all of my non-rotational programs. And yes, obviously we could be doing better, but we've been having an average return on our closed trades. And obviously we can only track our closed trades. 3.31% return every 23 days, 77.42 win rate, and a profit factor of 120 since October in this kind of market. Oh yeah, it's like that. So that's half of what the S&P gives you in a bullish year, but not in 365 days and 23 days with a 77.42% return. That's out of 155 trades that were taken between October 1st and yesterday. So this is real time. This is all the discretionary trades. So I haven't really been doing all that bad in this type of market cycle. I hope you guys have been enjoying some of these winners. And yes, it's been really tough lately, but I think the worst may be, or at least we may be getting into the bottom sideways turnaround area where it's just congestion, but not that much more downside. Most momentum indicators are pointing to higher prices or uncertainty, but most of the downside is priced in. Now, when everything from the S&P to the NASDAQ and even crypto are getting slaughtered, there's still a handful of stocks that push higher and higher. They're in motion. Now, Wall Street has been using the simple yet effective principle to grow its riches for decades. And we're seeing this phenomena take place in a handful of stocks right now. Most folks, we've been looking at stock market the past few months, are probably about to throw in the towel. I know how you feel. I've seen it. I've got emails from you guys. I mean, I'm hardly getting any love letters anymore. But that's only because they have no idea how much opportunity is still out there. And boy, oh boy, this is the time for opportunities. Click on the link below to find out more about a little known phenomena Wall Street has been using for decades. You guys got to check this out. And follow the link below. Check it out now. If you're watching on YouTube, go below the video on the Wealth Press YouTube channel and you'll see the link there. Next week, biggest threats, biggest opportunities. It's going to be an interesting Friday. I'm looking for a good turnaround over the next 10 days or so. At least there's a 68 to 75% chance. 75 on the Russell, 68 on the S&P. The Russell rallies between now and the end of the month, and the S&P rallies through the 4th of July holiday. 68% chance there. We'll talk about that on Monday. Have a great day, and send me some feedback if I've been keeping you out of trouble. Support at marketgeeks.com. It hasn't been easy. 10 out of 11 down weeks. It's been nuts. I'll see you guys on the other side. Bye.